In this video, we're going to talk about how to calculate a goodwill impairment. So now there's a single-step test for calculating the goodwill impairment under ASU 2017-04. There used to be a two-step test that was kind of complicated and costly for firms to implement under US GAAP, but that is no more. We now have a single-step test, and here's how goodwill impairments are calculated. We're going to take the carrying value of the reporting unit. Okay, so that's the value on the balance sheet. And then we're going to subtract the fair value of the reporting unit. And if that amount is greater than 0, then we're going to have a goodwill impairment. So that's a little abstract. Let me give you an example, and it's actually quite simple. So let's take a firm. Let's say that there's a company called Chimp Bicycles that makes bicycles for chimpanzees. Okay, so they make bicycles for chimpanzees, and your company pays $100,000 cash to acquire 100% of Chimp Bicycles. Now, here's what the balance sheet of Chimp Bicycles looked like before you purchased them. So they had cash, they had accounts receivable, inventory, a trademark, and then they had some liabilities. Okay, we've got the book values, but what we really care about, and this is just review on how to calculate goodwill, what we really care about is the fair value, because we're going to take the fair value of the net identifiable assets, and that's basically everything except goodwill. So the $3,000 of cash, $5,000 account receivable, $30,000 fair value of inventory, and then $25,000 fair value of the trademark. We're going to take all those, subtract the liabilities. That gives us $55,000 for the fair value of the net identifiable assets. And we're paying $100,000 to acquire this firm. So we take the $100,000 and then we subtract $55,000. That gives us $45,000 of goodwill. Okay, so we have $45,000 of goodwill. Now the question is, how do we impair it if something changes? So let's say that 1 year later, okay, we're testing for our goodwill impairment because we have to test every year at least. We test and we say, hey, the fair value of this Chimp Bicycles company is $80,000. So now what we do is we compare that to our carrying value. In this case, what's our carrying value? Well, it's $100,000. We paid $100,000 for this Chimp Bicycles. We've never impaired any goodwill or changed the value of this reporting unit before, right? So now we look and we see the fair value is $80,000. So we've got to do something. We have a goodwill impairment because the carrying value of $100,000, the value on the balance sheet, is higher than the fair value. So we're just going to take the difference. We're just going to take the $100,000 minus the $80,000. That's going to give us $20,000, and we're going to recognize a goodwill impairment. So we're going to debit goodwill impairment, which is an expense, right? It's going to reduce net income. So we're going to debit goodwill impairment for $20,000, and then we're going to credit goodwill for $20,000. Now, if you remember, we had goodwill on our balance sheet for $45,000 after we made that acquisition. So now we're going to subtract $20,000, and now we have a new value of goodwill of $25,000. Okay. Now, what if we had a situation where if we said, okay, 1 year later, instead of the fair value being, let's say, instead of it being $80,000, let's say the fair value was $10,000. So if we look and we say, okay, the carrying value is $100,000, and then now we look and say the fair value is $10,000, it would seem like we would have a $90,000 loss, right? Because if we update our numbers here, we had $100,000 carrying value minus the 10, the fair value, would seem like there would be a $90,000 goodwill impairment. But here's the catch. We only recognized $45,000 of goodwill when we initially acquired this Chimp Bicycles, right? So we only have $45,000 of goodwill, so we can't have a goodwill impairment of $90,000. It's not possible. So if, hypothetically, the fair value were to drop to $10,000 and our carrying value had been $100,000, our goodwill impairment would be $45,000 because that's the total amount of goodwill that we have. We can't go to 90. We only have $45,000 of goodwill. So in that case, we would debit goodwill impairment for $45,000 and credit goodwill for $45,000. And then at the end of that period on the balance sheet, goodwill would have a value of 0.